A holding company is a powerful business structure that owns and controls other companies without engaging in direct business operations itself. For business owners managing multiple enterprises, holding companies offer a strategic way to limit liability while maintaining ownership and control over each business. Holding companies, also known as parent companies, typically hold equity interests or assets, rather than actively participating in day-to-day operations. Any company underneath the parent company is called an operating company or subsidiary. This structure creates a central point of control while keeping each business legally separate. The advantages of establishing a holding company are significant. First, it provides centralized control, giving owners the ability to maintain direction over all subsidiaries. As the owner of each subsidiary, the holding company can select executive management teams to run each business effectively. Second, holding companies limit investment opportunities in beneficial ways. Interested equity investors can choose which specific subsidiary they want to invest in, rather than investing in the entire corporate structure. This targeted approach allows for raising capital and creating partnerships for each business individually. Third, and perhaps most importantly, holding companies limit liability. Assets of a subsidiary can be owned by the holding company and then leased to the subsidiary. If a subsidiary faces creditor claims or legal judgments, it wouldn't lose these assets because it doesn't technically own them. In extreme cases, a struggling subsidiary could declare bankruptcy while the holding company remains protected, preserving its assets and ability to establish new subsidiaries. The tax benefits of holding companies are substantial. Income generated by subsidiaries can be retained within the holding company, effectively deferring taxation until distributions occur. Many jurisdictions offer lower corporate tax rates on dividends received from subsidiaries. Holding companies can also offset losses from one subsidiary with profits from another, reducing overall tax liability. By separating valuable assets from operating entities, businesses can shield them from tax burdens associated with legal liabilities. For multinational operations, holding companies in tax-favorable jurisdictions can minimize tax exposure while streamlining global operations. Despite these advantages, holding companies come with certain challenges. Each subsidiary must maintain its own business formalities, including separate bank accounts, financial statements, meeting records, and distinct employees, managers, officers, and directors. This complex structure may confuse partners, employees, or other stakeholders who don't understand the separation of entities and their purpose. Intellectual property presents special considerations. An intellectual property holding company can be created to own and manage patents, trademarks, and copyrights, licensing them to subsidiaries for royalty fees. However, in cases of infringement, these entities may only be eligible for reasonable royalties rather than full lost profits. Regulatory compliance poses additional challenges for holding companies. Operating subsidiaries across different states or countries requires navigating varying tax laws, reporting obligations, and business regulations. The structure necessitates separate financial statements, regulatory filings, and governance structures for each entity, increasing administrative costs. Some jurisdictions impose strict reporting and transparency requirements, potentially limiting privacy benefits. Holding companies with significant market influence must also adhere to antitrust regulations to prevent monopolistic practices. How do holding companies generate revenue? They have multiple income streams, including profits and dividends from subsidiaries, interest and earnings from stock shares or bonds, fees for services provided to subsidiaries, and the buying and selling of assets, including stocks. Typically, the holding company establishes agreements with subsidiaries outlining operational budgets, service costs, and intercompany transactions. The level of involvement in subsidiary management varies, with some holding companies actively managing budgets and operations, while others intervene only when issues arise. Holding companies play a crucial role in succession planning and business continuity. They facilitate seamless ownership transfers across generations without disrupting subsidiary operations. Since subsidiaries operate independently, leadership changes at the holding company level don't directly impact daily operations. This structure offers estate planning advantages by allowing efficient distribution of ownership stakes among heirs, reducing estate taxes and avoiding probate complications. Additionally, if one subsidiary experiences financial difficulties, the holding company can protect other subsidiaries from adverse effects. In summary, holding companies provide business owners with a strategic framework for managing multiple enterprises while limiting liability and optimizing tax benefits. Though they require careful navigation of regulatory requirements and administrative complexities, the advantages of centralized control, asset protection, and succession planning make them valuable tools for business growth and longevity. For business owners seeking to expand their operations while managing risk, the holding company structure offers a compelling solution.